Artificial intelligence is being called the biggest technological shift since the internet. Companies investing in AI are spending hundreds of billions of dollars, and investors are pouring money into AI stocks, hoping to catch the next big wave. But here's what most beginners don't realize. The AI boom has a lot in common with the dot-com bubble of the late 1990s. Some companies will become the next Amazon. Most will become the next pets.com. In this video, I'm going to explain how AI investing actually works, the real risks, and the smartest way to get exposure without gambling your money away. Let's go. Welcome to Faceless Millionaire, where we break down investing without the hype. Quick disclaimer, this is educational content, not financial advice. AI stocks are volatile and risky. Only invest what you can afford to lose. Here's the truth. AI is real. The technology is transformational. But not every AI stock will make you rich. Most will lose you money. Let me show you how to separate real opportunity from dangerous hype. The AI investment landscape has 4 layers, from safest to riskiest. Let's break them down. Layer 1, chipmakers, the picks and shovels of the AI gold rush. During the 1849 gold rush, most miners went broke, but the people selling picks and shovels made fortunes. That's chipmakers in the AI boom. Nvidia, the king, makes GPUs, graphics processing units, that power AI training. Every AI company needs Nvidia chips. Stock is up over 1,000% in 5 years. But P/E ratio is around 60, meaning you're paying $60 for every dollar of earnings. S&P 500 average is 20. You're paying triple the market average. AMD, competing with Nvidia. Cheaper valuation, smaller market share. Higher risk, higher potential reward if they catch up. TSMC, Taiwan's semiconductor manufacturing company. They manufacture chips for Nvidia, Apple, AMD, everyone. Less sexy than Nvidia, but critical to the supply chain. Intel, the old king trying to catch up, falling behind in AI chips. Turnaround story, high risk. Layer 2, cloud providers, the infrastructure companies. These are the giants who already dominate cloud computing and are adding AI services on top. Microsoft, partnered with OpenAI. ChatGPT runs on Microsoft Azure, selling AI tools to enterprises. Huge advantage. Amazon, Amazon Web Services, offers AI infrastructure. Companies use Oz to build and run AI applications. Google created the transformer technology that powers most modern AI. Google Cloud competing with Oz and Azure. Why these are safer than pure AI plays. They already make massive profits from cloud services. AI is growth on top of existing business. If AI hype slows, they still make money. Layer 3, software companies integrating AI into existing products. Adobe, AI in Photoshop, Illustrator, video editing. Firefly AI, selling to existing customer base. Salesforce, AI in CRM, customer relationship management. Einstein AI helping sales teams. These are established companies adding AI features. Safer than pure AI startups because they have real revenue and customers already. Pure AI plays. C3.ai, Palantir, Databricks, Snowflake. These are software companies focused entirely on AI or data that powers AI. Higher risk, higher potential reward, but also higher chance of going to zero if AI hype collapses. Layer 4, everything else claiming AI. Companies adding AI to their press releases, AI in the company name, AI buzzwords everywhere. But no real AI revenue. This is the most dangerous layer. Most of these companies will fail. Avoid unless you're an expert who can evaluate their actual business. Recap, chipmakers, infrastructure, software, everything else, safest to riskiest. Most beginners should focus on layers 1 and 2 only. Now let's talk about the dot-com bubble. Because history is repeating. 1997 to 2000. The internet was exploding. Everyone knew it was revolutionary. Investors poured money into anything with .com in the name. Pets.com. Sold pet supplies online. Went public. Stock soared. Company had no profits. Business model didn't work. Went bankrupt 9 months after IPO. Webvon. Online grocery delivery. Raised $800 million. Spent it building massive infrastructure. Customers didn't come. Bankrupt in 2 years. Cosmo.com. On-demand delivery. Free delivery of anything in an hour. Unsustainable business model. Burned through money. Dead. What survived? Amazon. Lost money for years. Investors thought it would fail. It didn't. Built the dominant e-commerce platform. Google. Started in 1998. Focused on search. Became the gateway to the internet. The pattern. Most .com companies failed. A few became the most valuable companies in the world. Fast forward to today. Same pattern with AI. Companies adding AI to press releases even if they don't have real AI products. Stocks jumping 20 to 30% on AI announcements. Investors buying anything AI related without understanding the business. This is dangerous. Just like .com, most AI companies will fail. A few will dominate. How to survive. Don't try to pick the winners. Own them all through diversification. Or own only the established companies with real revenue and profits. Let's talk about valuations. Because this is where beginners get destroyed. P/E ratio. Price to earnings. How much you're paying for each dollar of company earnings. If a stock trades at $50 and the company earns $1 per share, that's a P/E of 50. S&P 500 average P/E, around 20. You pay $20 for every dollar of earnings. Nvidia, P/E, around 60. 3 times the market average. C3.ai, P/E, over 100. 5 times the market average. Some AI stocks, no earnings at all. Infinite P/E. You're paying for pure future potential. What this means, you're betting on massive future growth. If that growth happens, you win big. If it doesn't, the stock crashes 50 to 80%. High P/E stocks are high risk. When the market gets scared, these stocks get crushed first. 2022. Tech stocks crashed. Nvidia dropped from 300 to 100. 66% decline. Many AI stocks dropped 70 to 80%. If you bought at the top, you lost most of your money. Even though AI is real and growing. The lesson. Valuation matters. Even great companies can be bad investments if you overpay. Don't buy AI stocks just because AI is exciting. Look at the price you're paying. Here's what most beginners don't realize. If you own a broad market index fund, you already have significant AI exposure. Look at the top holdings of VIT, Vanguard Total Stock Market, or VU, Vanguard S&P 500. Number 1 holding, Microsoft, 6 to 7% of the fund. Microsoft is one of the biggest AI investors in the world. OpenAI partner, Azure AI. Number 2, Apple, 5 to 6%. AI and iPhone Siri on device AI processing. Number 3, Nvidia, 4 to 5%. The AI chip king. Number 4, Amazon, 3 to 4%. Oz AI services. Number 5, Google, 3 to 4%. AI research leader, Gemini, Cloud AI. Add them up. Your S&P 500 index fund is roughly 20 to 25% invested in the top AI companies. You already have AI exposure. Through diversified, profitable, established companies. Why this is better than buying individual AI stocks. Diversification. If one AI company fails, you still own the others. Plus 475 non-AI companies. Lower risk. These companies make money outside of AI too. They're not pure AI bets. For most beginners, this is enough. Keep buying VT or VU. You're invested in AI. You're diversified. You're safe. Don't overthink it. If you want more AI exposure than a broad index fund provides, AI-focused ETFs are the next step. AI ETFs. Exchange-traded funds that hold 30 to 80 companies involved in AI, robotics, and automation. BOTS. Global X Robotics and AI ETF. Holds companies in industrial robotics, automation, and AI. Expense ratio 0.68%. Robo Global Robotics and Automation Index ETF. Similar to bots. More global exposure. Expense ratio 0.95%. Think Robo Global Artificial Intelligence ETF. Focuses more on AI software and services. Expense ratio 0.68%. These ETFs spread your money across dozens of AI companies. Chipmakers, cloud providers, software, robotics, AI applications. You're not betting on one company. You're betting on the entire sector. Pros, diversification within AI. Professional management, easy to buy and sell. Cons, higher expense ratios than broad index funds. More volatile than S&P 500. Still concentrated in one sector. Suggested allocation, 5 to 10% of your portfolio max. If you're aggressive and believe in AI long-term. Keep the other 90 to 95% in broad market index funds. Example, you have $100,000 total portfolio, $90,000 in VITI, broad market, safe, $10,000 in bots or think, AI focused. Higher risk, higher potential reward. This gives you AI exposure without gambling your entire portfolio. Now let's talk about buying individual AI stocks. This is the riskiest approach. Only consider this if you can afford to lose 50 to 80%. Only with money you don't need. Maximum 5 to 10% of total portfolio. If you're going to do it, here's the smart way. Stick to established, profitable companies with real AI revenue. Not startups. Not companies with no earnings. Microsoft, safest AI play. Already profitable. OpenAI partnership. Azure growing. Nvidia, the chip leader, proven business, but expensive valuation. Amazon, Oz AI services, diversified business beyond AI. Google, AI research leader, profitable core business in search and ads. Avoid pure AI startups with no profits. C3.ai Palantir. These might win big, but most will fail. Unless you're an expert who can evaluate AI technology and business models, stay away. If you buy individual AI stocks, diversify. Don't put everything in Nvidia. Spread across 5 to 10 companies. Chips, cloud, software, different layers. If one sector gets hit, you still have others. Reality check. Even professional investors struggle to pick winning stocks. 90% of active fund managers underperform the index over 10 years. You're not smarter than them. Don't bet your financial future on picking the next Nvidia. Let me give you 3 portfolio strategies. Conservative, moderate, aggressive. Conservative, recommended for beginners. 90% broad market index funds. VT, VU, FSROX. 10% AI-focused ETF if you want extra exposure. 0 individual AI stocks. Why this works? You get AI exposure through the broad index. Microsoft, Nvidia, Amazon, Google are already top holdings. The extra 10% in AI ETF gives you more concentrated exposure if you believe in the sector. But 90% is still safe, diversified, broad market, moderate. For investors with some experience, 80% broad market index funds, 15% AI-focused ETF, 5% individual AI stocks. Only Microsoft, Nvidia, Amazon, Google. The established players. Aggressive. Only if you're experienced and can handle volatility. 70% broad market index funds, 20% AI-focused ETF, 10% individual AI stocks, diversified across 5 to 10 companies. Critical rule, never go all in on AI. Ever. I don't care how much you believe in the technology. I don't care how much FOMO you feel watching Nvidia go up. Never put your entire portfolio in one sector. That's gambling, not investing. BlackRock projects $5 to $8 trillion in AI capital expenditures through 2030. AI is real. It's growing. But that doesn't mean every AI stock will win. Stay diversified. Protect yourself. Let's wrap up with common mistakes beginners make with AI investing. Mistake 1. chasing stocks that already went up 1,000%. Nvidia is up 1,000% in 5 years. That doesn't mean it will go up another 1,000%. Most of the easy gains are gone. You're buying high. Mistake 2. Buying companies just because they have AI in the name or press release. Most of these companies have no real AI revenue. They're riding the hype. When the bubble pops, they go to zero. Mistake 3. Ignoring valuation. A great company at a terrible price is a bad investment. Don't buy AI stocks with P/E ratios over 100 unless you deeply understand the business. Mistake 4. Putting your entire portfolio in AI. Diversification is the only free lunch in investing. Don't give it up just because AI is exciting. Mistake 5. Trying to time the market. You can't predict when AI stocks will crash or rally. Dollar cost average. Invest consistently. Let time smooth out volatility. Mistake 6. Forgetting you already own AI through index funds. If you own VTI or VU, you own Microsoft, Nvidia, Amazon, Google. You don't need to buy more AI. You're already exposed. Let's bring this together. AI is real. The technology is transformational. Companies are spending trillions on infrastructure. But the AI stock boom looks a lot like the dot-com bubble. Some companies will become Amazon and Google. Most will fail. The smart approach for beginners. Keep 90% in broad market index funds. You already own the top AI companies through VTI or VU. If you want extra AI exposure, put 5 to 10% in an AI-focused ETF. Bots. Think. Robo. If you must buy individual AI stocks, stick to established profitable companies. Microsoft, Nvidia, Amazon, Google. 5 to 10% max. What not to do. Don't go all in. Don't chase hype. Don't buy companies with no earnings. Don't ignore valuation. Don't gamble your financial future. If you're new to investing, watch my video on how to start investing with $100 before buying any AI stocks. And watch my video on what actually happens when you buy a stock to understand the basics. Links in the description. If this breakdown helped you understand AI investing without the hype, hit that like button. If you want more smart investing strategies for beginners, subscribe to Faceless Millionaire. Now tell me, do you own any AI stocks or ETFs? Or are you sticking with broad index funds? Drop your strategy in the comments. AI is the future. But don't let FOMO destroy your financial present. Invest smart. Stay diversified. Build wealth slowly. Thanks for watching. I'll see you in the next one.